Hello friends, Michael with you today as always, and I trade binary options on the PocketOption platform. And I want to inform you that in the description of this video you'll find a link to my private Telegram channel where you will find a lot of really useful and cool information about trading signals and etc. So I also recommend you to go there because you will have a personal link to register on PocketOption platform and get you 50% free on your deposit. So today I start our lock in the deposit from $200 as usual. I will enter into a deal for all 100%. I see that the price has strongly impulsed and rolled back, but I think that it still has a lot of liquidity. So I go into the purchase at 100%. I propose today to continue one of the topic's basic concepts of technical analysis. Development of highs and lows. Now we all hang out in computer and stare at cats there. In parallel, traders have developed a lot of complex algorithmic systems to determine market trends. Some of these systems are quite good, others absolutely suck. But as a result, it turned out interesting. Traders got so carried away with complex systems that they completely forgot about the simplest, basic methods of technical analysis. And one of them is the method of maxima and minima. This is another brick of our amount of evidence that we discussed earlier. It is also an element of several price patterns. The deal closed at $308. And now I think I can go on sale at 100%. As I said, the concept is simple in general, but it's not a rocket science. As you know, a growing trend always has ups and downs, and at the same time, each maximum is greater than the previous maximum, as well as each minimum is higher than the previous one. And when the series of highs and lows is interrupted, this is a signal for a trend reversal. The significance of the highs-lows reversal is determined by the duration of magnitude of the price rises and falls. For example, the more the better. For example, if each wave takes 2 or 3 weeks to complete, therefore the price reversal will be average. Since the average price movement consists of a set of such short-term 2 or 3 week movements, accordingly, if the waves of falling average trends are interrupted by an upward reversal signal, this is an indication that the main trend is moving from a bearish to a bullish state. And what do the effective highs and lows look like? As a rule, trends and pullbacks are quite obvious, so it is very easy to determine the highs and lows. Usually the rollback to the previous trends should be from 1/3 to 2/3 of its size. In other words, if we take the first wave from the minimum to the subsequent maximum in figure 2 to 9 for 100%, then the correction should be from 1/3 to 2/3 of this movement. In our case, it turned out to be half of or 50% of the previous movement. Sometimes the rollback can be 100%. The deal brought us $514.36. I think the price will continue to fall, so I go on sale at 100%. Technical analysis, as you remember, is an art, not an exact science. However, if the rollback is significantly less than minimum 1/3, then the current minimum or maximum will be under suspicion. There is one exception. From time to time, the correction turns into a sideways trend and not into a rising or falling trend, since the trading range will be against the main trend, and this indicate a psychological correction. The 1/3 and 2/3 rule will be still in force. At the same time, the movement time will be more important than its size. The same things applies to sideways and trends in falling markets. It is also important for us to figure out which trend we are looking at. For example, if a reversal after a series of ups and downs lasts 2-3 weeks, therefore we have a medium-term reversal which will consist of short-term trends. On the other hand, the reversals at the highest lows that are observed on intraday charts will be more significant than on very tiny time frame. Here, of course, everything depends on what do we mean by tiny time frame, because then they can consist of hour candles or 5-minute candles. The deal closed at $900. So now we can turn around and go into the purchase of 100%. Arithmetic or logarithmic graphs. Arithmetic or logarithmic graphs, sorry. So what, folks, did you not know that these candles are different? Not surprising, actually. There are, of course, two axes on any market chart. The x-axis runs at the bottom and indicates time, except for knots and crosses charts. And the y-axis always indicates the price. So there are two methods for displaying the y-axis: arithmetic and logarithmic. So, and they differ specifically the cross on the belly. Arithmetic graphs display a certain distance in points or dollars vertically. In the graph below, each arrow has the same vertical distance, which is approximately 200 points. And that's exactly how it will be at any time frame and at any price level. But for a logarithmic graph, the vertical distance is taken into account as a percentage. In the following chart, each arrow has a movement of approximately 100% for falling on or rising prices. If there is a short period of time on the chart, then the differences between the different types of charts will be insignificant, because the price movement is quite insignificant. The deal closed at $1,575. For today, I'm finishing with overclocking. I started with $200 and I'm finishing with $1,575. I thank you guys for watching this video. Don't forget to write, to comment, to like, to subscribe, and to go via the link where you can pick up a nice bonus. And share this video with a friend, or with your girlfriend, or with your dog or cat or parrot or hamster, or okay, you've got my point. So share this video with anyone who is interested in trading and wants to get a lot of money. So that's all for now, guys, and I wish you only successful trading sessions. And goodbye till the next video, guys. Michael was with you, and bye.